The bull market genius who became a bear market casualty, Dunning-Kruger in investing. Good morning, investors. I want to start today with a question, and I want you to answer it honestly, not out loud, just to yourself. Between 2020 and 2024, during one of the greatest bull runs in Indian market history, did you start to feel that you were better at investing than you had previously thought? Did your returns confirm something you had quietly suspected about yourself? That you had a good eye for this, that your instincts were sound, that perhaps you did not need as much guidance as you once thought? If the answer is yes, this tip is for you. And I say that with complete respect because the answer is yes for almost every investor who lived through that period, including many who should have known better. What you experienced has a name, and it was identified in a landmark psychology paper published in 1999. The research, David Dunning and Justin Kruger, psychologists at Cornell University, published a paper in the Journal of Personality and Social Psychology titled Unskilled and Unaware of It. Their finding was both simple and devastating. People with low ability in a specific area systematically overestimate their competence, not because they are foolish or arrogant, but because the same lack of skill that makes them perform poorly also prevents them from recognizing how poorly they are performing. The very knowledge you would need to evaluate your own performance accurately is the knowledge you do not yet have. In their original studies, participants who scored in the bottom quarter on tests of logical reasoning and grammar estimated that they had performed in the 62nd to 68th percentile, well above average, when in reality they had scored near the bottom. They were not lying, they genuinely believed they had done well, because they lacked the skill to recognize how much they did not know. Dunning and Kruger described this as the most dangerous form of incompetence, not the kind that knows itself, but the kind that does not. What happened in India between 2020 and 2024? Between April 2020 and September 2024, the Sensex rose 150%, 150% in 4 years. Thematic funds delivered 30%, 40%, 50% returns. Small caps exploded, mid caps followed. Virtually every fund, every stock, every strategy seemed to be working. In that environment, something very human happened. Investors started to feel good about their decisions, and that feeling, which felt like growing expertise, was actually something quite different. Millions of new investors opened demat accounts during this period. Many switched from regular plans to direct plans, cutting out their distributors, because they felt confident enough to manage their own portfolios. The bull market was providing constant reinforcement. Every return statement said, "You are doing well. You know what you are doing. You do not need help." Then came October and November 2024, a 10% correction. Foreign institutional investors pulled out 1.6 lakh crore from Indian markets in just 2 months, and the investors who had been quietly certain of their own genius discovered something that no bull market had prepared them for. The market had been doing the work, not them. Their returns were not evidence of skill. They were evidence of timing, of being in the market during one of the strongest runs in Indian market history. Almost any strategy would have worked. Almost any fund would have delivered. The bull market had made everyone look competent, including those who were not. SPIVA India, S&P Indices versus Active India, which independently tracks active fund performance against benchmarks, found that 82% of active large cap fund managers in India underperformed the Nifty 100 over 10 years. Think about that. These are professionals, full time, supported by teams of analysts with Bloomberg terminals and proprietary research and years of experience. 82% of them could not consistently beat the index over a decade. So, what does that tell us about the retail investor who spent a few evenings reading financial blogs, watched a few YouTube videos about fundamental analysis, and decided they knew enough to manage their own portfolio without professional guidance? It tells us they may be at the most dangerous point on the Dunning-Kruger spectrum. They know enough to feel confident. They do not yet know enough to know the limits of that confidence. The signs to watch for. I want to give you 3 specific signs that you may be in this trap right now. First, you have reduced or stopped consulting your distributor or financial advisor because you feel you have learned enough to handle it yourself. Second, you are making more frequent changes to your portfolio, switching funds, timing entries, chasing themes based on your own research rather than a long-term plan. Third, your recent returns have confirmed your approach, but you have not asked yourself honestly whether the market environment, not your skill, was responsible for those returns. That third sign is the most important because in a bull market, almost every strategy works. The real test of skill is not what happens when everything goes up. It is what happens when it does not. The antidote. The antidote to Dunning-Kruger is not humility for its own sake. It is calibration. The best long-term investors, and I have observed this over many years, are not the most confident. They are the most honest about what they know and what they do not. They seek second opinions. They question their own conclusions. They understand that the market is a system of extraordinary complexity and that even decades of experience do not make anyone immune to being wrong. Warren Buffett, who has spent over 60 years studying markets, still consults Charlie Munger, still reads extensively, still questions his own assumptions. If Buffett needs a second opinion, what does that tell us about the rest of us? The real lesson. A bull market is a wonderful thing. It creates wealth, builds confidence, and brings new investors into the system. But it also creates a dangerous illusion that the returns were personal, not cyclical. That the skill was yours, not the market's. Dunning and Kruger proved in 1999 what every experienced investor eventually discovers. The less you know, the more certain you feel. And the more you learn, the more clearly you see how much further there is to go. My WealthWise pin-up rule for today. A bull market makes everyone feel like a genius. A bear market reveals who actually was one. The question is not whether you made money between 2020 and 2024. The question is, do you know why? Tell me honestly in the comments. During the 2020 to 2024 bull run, did you feel your investing confidence growing? Did you reduce your reliance on professional guidance? And how did October 2024 feel when the correction came? This is a safe space for honest conversations. Drop your experience below. I am MV Suresh, founder MV Suresh WealthWise. For regular mutual fund updates, connect with me on Facebook, Instagram, LinkedIn, YouTube, and Telegram. Wishing you good financial health. I'll be back tomorrow with a new tip. Till then, stay wealthwise.